Varius.
What's going on YouTube? This is Andreas from MyBankersInsights with another video, and in this video I'm going to be going over one investment that you can make that requires very little research, helps you diversify your portfolio, and requires very little work. Now if you can guess what it is already, go ahead and comment down below. Now if you haven't already, or if you're new to the channel, go ahead and subscribe. I drop a new video once a month going over personal finance, stocks, investing, and everything you need for your financial needs. So without further ado, let's get into this video. In this video I'm going to be talking about index funds. Starting with, what are index funds? An index fund is a type of investment that mirrors the performance of a market index, like the S&P 500. Basically, this does exactly what the S&P 500 does, but in a smaller capacity, giving you the same amount of returns. So what is the S&P 500? The S&P 500, or the Standard & Poor, tracks the performance of 500 of the largest companies listed on stock exchanges. You can't invest in a market index itself, but you can invest in an index fund that tracks that market index. And your index fund will perform similarly to that market index. Now to give you a little bit of a history on the S&P 500, the S&P 500 was introduced in 1957 by someone named John Bogle as a market index to track the value of 500 corporations listed on the New York Stock Exchange and the NASDAQ Composite. From 1969 to 1981, the index gradually declined while the US economy endured stagnant growth and high inflation, kind of similar to what we're seeing now. The S&P 500 also fell more than 40% during the 2008 financial crisis and Great Recession in 2008, but recovered all of its losses by 2013. In 2020, the pandemic also made the S&P 500 drop a significant amount, but by 2021, the S&P 500 was at an all-time high. What that tells you is that even though you see these big declines that happen in 2020 and 2008 and before, that the market always goes up eventually. So when you invest, you really want to be investing for the long term and being aware of all these things that are happening. Now, how does an index work? To understand how an index works, it's important to understand the difference between active and passive management. Active management is when an investment manager actively chooses when to buy and sell. And since someone is doing all the work, a lot of times when you invest in an actively managed portfolio, there are higher fees associated with investing in those sorts of investments. Passive management, on the other hand, is a strategy where a fund manager builds a portfolio that reflect an existing index, such as the S&P 500. This way, the performance of the index fund usually mirrors closely that of the index itself. So no hands-on management is necessary. And the fees associated with investing in that sort of investment are a lot less than one that is actively managed. Now, an example of an actively managed portfolio would be a mutual fund. Now, you've probably heard about mutual funds, ETFs, and index funds, but no one really goes over what the differences are. So to break them down, when you invest in a mutual fund, you're investing in an actively managed portfolio. The benefit of that is it allows you to invest in hundreds of stocks all at once. Usually mutual funds have a minimum of 90 stocks in the fund, which offers a lot of diversification, so you can have a bunch of investments all grouped in one stock. And they're managed by a professional, so instead of you going and buying and selling stocks and shares, someone else is doing it for you. But again, since someone else is doing it, the fees associated with a mutual fund are a lot higher. Generally, the fees are about 1 to 2% of your account portfolio. So you want to be really picky about which mutual fund you invest in, because those fees are charged no matter if that mutual fund is doing good or bad. But on top of that, you also have a tax liability whenever the fund trades its holdings, even if you don't sell your shares or your holdings. Now let's go over what an ETF is. Now an ETF is very similar to an index fund. A lot of times you'll hear people say ETFs and index funds interchangeably, but they are not the same. In my opinion, I would invest in index funds instead of ETFs because you won't be as tempted to sell as frequently and will hold on to it long term. And index funds offer automatic reinvestment, which will automate a lot of the work that you have to do while you're investing, making it easier for you to build long-term growth and take advantage of compounded interest. Compounded interest is the interest calculated based on the initial principal and the accumulated interest from previous periods. For example, if you deposit $1,000 into an account that pays 1% interest annually, you'd earn $10 in interest after a year. Now, if you're auto reinvesting the interest, in year 2, you'd earn interest on $1,010 instead of the $1,000 that you started with. So it's the principal plus interest. Now, that doesn't seem like a lot, but imagine if you continue to invest your own money plus the interest that you get. The average annual return of the S&P 500 is close to 10% annually. Now, here are the type of index funds that you can invest in now. My personal strategy for investing in index funds is to dollar cost average, which means instead of buying shares at a single price point, with dollar cost averaging, you buy smaller amounts every month regardless of the price. Long-term studies have shown that dollar cost averaging is the best way to build wealth long-term, as opposed to lump sum investing, which is where you take all your investable cash and invest it all at one time. But as always, I recommend that you do your own research and figure out which way would be best for you. So I hope by now you know the differences between an ETF, a mutual fund, and an index fund. Now, as far as where you can buy index funds, you can buy index funds through a brokerage account or directly from an index fund provider like Vanguard. I'll also put a few links down below for some brokerage accounts that I like and that I personally use to invest. For more videos on investing and building your wealth, subscribe and hit the bell notification. I put out a new video once a month. If you have any questions at all, comment down below and I'll try to get to you as soon as possible. Stay tuned for more videos coming out soon, and I will see you next time.